everyone, and welcome. Today, we're going to tackle a question that, let's be honest, trips up just about every modern business. When you build a website, are all those costs an immediate hit to your profit, or are they a long-term asset? It's a really critical accounting puzzle, so let's get right into it. So, imagine this. You're finally building that new website. You're paying designers, developers, maybe even content creators. The big question is, what do you do with all those costs? Do they hit your income statement right away as an expense, shrinking this year's profit? Or can you put them on your balance sheet as a long-term asset? It's a huge decision, but luckily for us, there's a specific rulebook to guide us. And that rulebook is SIC-32. You can think of it as the official standard that tells you exactly how to account for every single dollar you spend on building a website. The real key is that it breaks the whole process down into different stages. So let's walk through them one by one. All right, first step is the planning stage. This is where it all begins, right? The brainstorming sessions, the big ideas, all those what-if conversations. Now, according to SIC-32, the planning stage covers pretty much everything you do before the actual build starts. We're talking about things like feasibility studies, to see if the project is even a good idea. It also includes defining your goals, checking out different platforms or agencies, and finally making your choices. And here's the first crucial link for all you accountants out there. SIC-32 actually says that this planning stage is similar in nature to the research phase under the main standard for intangible assets, which is IS-38. This connection is everything because it tells us exactly how we need to treat these costs. And because it's treated like research, the rule is crystal clear. All costs from the planning stage have to be recognized as an expense, immediately. You can't save them up to create an asset later on. The bottom line is, all that early stage thinking hits your profit and loss statement right away. No ifs, ands, or buts. Okay, next up is the development stage. We're past the ideas phase now, and the website is actually starting to take shape. This is also where the accounting rules get a lot more interesting. So the development stage is really broken down into three main activities. First, you've got application and infrastructure. Think of this as the technical backbone, getting a domain name, writing the code. Then there's graphical design, which is all about the look and feel. And finally, content development, which is creating all the text, images, and videos that are going to live on the site. And just like before, there's another direct link to that main accounting standard. The development stage of a website is seen as similar in nature to the development phase under IAS 38. Now, this is a really critical distinction because, unlike research costs, development costs can sometimes be turned into an asset. So here's the million-dollar question. Can you capitalize these development costs? Well, the answer is a conditional yes. SIC-32 says you can, but, and this is a big but, only if you can prove the website will generate probable future economic benefits. Honestly, this is the single most important test you have to apply.
Let's make this real. A perfect example is an e-commerce website. A site that directly takes customer orders and processes payments? That clearly meets the test. It's a no-brainer. You can draw a straight line from the website's existence to future cash coming in the door.
And hey, just a quick timeout. For anyone who's wondering, when we say capitalize, what we really mean is treating a cost as an asset on your balance sheet. This means its cost gets spread out over its useful life through amortization, instead of hitting your income as an expense all at once. But here comes the really crucial exception. What if your website doesn't actually sell anything directly? What if it's developed solely or primarily just to promote and advertise your products and services? Well, in that case, SIC-32 is very clear. You can't demonstrate those future economic benefits, so all the development costs have to be expensed as they happen.
Let's make this super practical. The cost of programming the shopping cart and the checkout function for your brand new online store, that is directly tied to generating revenue. You capitalize it. Simple as that.
Okay, but what about the cost of hiring a photographer to take amazing digital photos of your products for that same store? Well, SIC-32 sees this as advertising and promotion. That cost has to be expensed when it happens, even though the photos are for the exact same website. It's a subtle but really critical distinction. So your website is planned, it's built, and now it's finally live. This brings us to the third and final phase, the operating stage. This is all about the day-to-day upkeep. The rule here is generally pretty straightforward, thankfully. Once the site is up and running, all those day-to-day costs, like updating your blog, minor bug fixes, just general maintenance, are recognized as an expense as soon as they happen. They're just keeping the website in its current condition. They're not adding some major new capability. All right, that was a lot to cover. Let's pull this all together and do a quick summary of the key accounting rules. This table really lays it all out. In the planning stage, think feasibility studies, the treatment is always expense. Done. In the development stage, like building that e-commerce platform, you can capitalize, but only if it's going to generate probable future economic benefits. And remember, pure advertising sites have to be expensed. Finally, in the operating stage, things like daily content updates, the treatment is expense. That, right there, is the core logic of SIC-32. We'll end with a final, practical piece of wisdom, and this comes directly from the standard itself. Even when you can capitalize a website, the rules say its, quote, useful life should be short. It's a quiet little acknowledgement that in the digital world, technology and design get old incredibly fast. It's a great reminder that good accounting often just reflects reality. Thanks for joining us.